Why do so many people enter the market full of hope, only to leave with smaller accounts, more stress, and quiet regret? If trading is supposed to be about numbers and logic, why does it feel so emotional, so personal, and so painful for so many Americans right now? For a lot of people in the US, money has become a daily source of anxiety. Inflation eats away at paychecks. Groceries cost more. Rent keeps rising. Savings accounts don't feel safe anymore. So when the stock market shows up on your phone through apps like Robinhood, Fidelity, or Charles Schwab, it looks like a way out. A way to catch up. A way to breathe. But for about 95% of traders, that hope slowly turns into loss. This is Crypto Brain Power, a channel created to help beginners understand markets without pressure, without hype, and without pretending this is easy. The goal here is simple. Learn how markets actually work, why people struggle, and how patience and understanding matter more than excitement. Before we go deeper, tell me in the comments what stock market topic you want explained next. Real questions, real confusion. That's how this channel grows. Subscribe to support the channel and continue learning with us. Most people don't lose money in trading because they are stupid. They lose money because they are human. The first mistake usually starts before the first trade is even placed. It starts with expectations. Social media shows screenshots of fast profits. Short clips make it look like buying Tesla in the morning and selling by lunch can change your life. Nobody posts the quiet losses. Nobody talks about the weeks where nothing works. So new traders enter the market believing speed equals success. Then reality hits. You buy a stock because it's trending. Maybe Apple after a strong earnings report. Maybe Amazon because everyone says e-commerce is unstoppable. The price drops the next day. Fear kicks in. You sell. A week later, the stock recovers and moves higher without you. That small loss doesn't feel small anymore. It feels personal. This is how emotional trading begins. Markets don't move in straight lines. Even the S&P 500, which represents some of the strongest US companies, has gone through brutal drops. Think about 2008. Think about March 2020. Think about recent years when Federal Reserve meetings sent markets up one week and down the next. Long-term investors survived those periods. Short-term traders often didn't. Another reason people lose money is confusion between investing and trading. Investing is about ownership. Trading is about timing. Timing requires experience, emotional control, and risk management. Most beginners have none of those, yet they jump straight into trading because it feels more exciting. A new trader opens an app, sees green and red numbers moving every second, and feels like they must act. Doing nothing feels wrong. But in markets, doing nothing is often the hardest and smartest move. There's also the problem of information overload. One day CPI data comes in hotter than expected, and markets fall. The next week, a jobs report shows strength, and markets rise. Then a Federal Reserve chair speaks, and everything changes again. Beginners try to react to every headline. They believe understanding the news means predicting the market. It doesn't. Professional traders spend years learning how to manage risk before they focus on making money. Beginners focus only on profit. That gap is where losses live. Leverage is another silent killer. Options, margin, complex strategies that promise faster results. They magnify gains, yes, but they magnify losses even faster. One bad decision can erase months of progress. Most people don't respect how quickly risk compounds when leverage is involved. Then there's impatience. Americans are used to fast results. Same-day delivery, instant streaming, real-time notifications. Markets don't work on that timeline. Apple didn't become Apple in a year. Amazon wasn't Amazon after its first stock rally. Long-term value takes time to reveal itself. Many traders also skip the boring part, studying financial statements, understanding why a company earns money, learning how interest rates affect valuations. Boring doesn't get clicks, but boring builds foundations. And when losses happen, ego gets involved. Instead of stepping back, people trade more. They try to win it back. This is where accounts quietly disappear. Not from one big mistake, but from many small emotional ones stacked together. The truth is uncomfortable. Most people would be better off slowing down. Learning how markets behave over years, not days. Watching how the S&P 500 reacts to economic cycles. Understanding that uncertainty is normal, not a signal to panic. Markets reward discipline, not urgency. Patience, not excitement. Consistency, not prediction. If you've lost money trading, you're not alone. Almost everyone who stays in the market long enough has paid some tuition. The lesson isn't to quit learning. The lesson is to respect the process. Real confidence doesn't come from winning a trade. It comes from understanding risk, accepting uncertainty, and staying calm when prices move against you. That mindset doesn't make headlines, but it keeps people in the game. Over time, clarity replaces confusion. Fear turns into caution. And the need to be right turns into the ability to wait. That's when the market stops feeling like a casino and starts feeling like a system you can navigate. Slowly, thoughtfully, and with humility. This video is only for educational purpose, not financial advice.